Consider what school taught you extremely well: punctuality, compliance, linear thinking. Study hard, perform well, follow the correct sequence, and the reward arrives at the end. These constitute the exact qualities that shape an individual into an excellent employee and a hesitant owner. The schooling was not fragmented. It served as perfect preparation for a destination you never consciously chose. Your salary is not a reward. It does not objectively reflect the market-based value of your time, your expertise, or the value you produce. It is a number calculated to solve a specific problem your employer has, which is preventing you from leaving to launch a competitive enterprise. Everything else is presentation. Every business that employs people is running the same arbitrage. They capture value from labor at a price lower than that labor actually generates, and they keep the difference. It is the margin the business exists on, but it means, structurally, that every salary is by definition lower than the value the person receiving it creates. If it were not, the business model would not function. Machiavelli observed that princes do not compensate their advisors according to what those advisors are worth. They pay what is required to maintain loyalty and prevent defection. The calculation has nothing to do with value. It is entirely about the cost of keeping someone inside the structure rather than outside it building their own. The same logic governs every employment relationship without exception. Your employer did not determine your salary by measuring your output and paying you its true market equivalent. They determined it by calculating the minimum necessary to keep your attention directed at their business rather than your own. That number and the number representing your actual productive value to the organization are almost never identical. The gap between them is the business. The implication is that understanding the structure of the arrangement changes how you operate inside it. You are not participating in a meritocratic exchange where harder work produces proportionally greater return. You are participating in someone else's system, and the returns from that system flow to the person who owns it. You are not paid what you are worth. You are paid what you would accept to not build something of your own, and those two numbers are almost never the same. There is a ceiling built into every job, and no amount of discipline, excellence, or extra hours can move it, because the constraint is not effort. It is the number of hours in a day. School presents work as the fundamental engine of financial progress. Work hard, earn money, save money, repeat. This model is not entirely wrong as a survival strategy. As a wealth-building strategy, it has a structural ceiling that most people spend entire careers never escaping, because it is built entirely on the sale of time, and time cannot be expanded. There are 24 hours in a day. Perhaps 8 to 10 are available for productive work. Multiply those hours by whatever rate the market pays for your particular skills, and you have the absolute ceiling of what employment can produce for you. That is not a challenge. It is not a limitation you can outwork. It is arithmetic. Assets operate outside that constraint entirely. An asset, in the precise sense the term requires, is anything that generates income independent of your active presence. A rental property producing monthly cash flow while you sleep. An equity position in a business whose systems run without your involvement. Intellectual property generating royalties from transactions you are not present for. A distribution channel selling to people you have never met at hours when you are not awake. The asset does not require your presence. A job pays you when you show up. An asset pays you whether you show up or not. One is income, the other is architecture. Most people with high salaries have high income and zero architecture underneath it. The moment they stop working, because they are sick, laid off, or simply exhausted, the income stops completely. A high income is not financial freedom. It is a well-compensated form of the same dependency that exists at every other income level. If the income stops the moment you stop working, you do not have a financial life. You have a very elaborate, occasionally well-compensated dependency. The tax code is not a burden distributed equally across the population. It is a reward system, and like every reward system, it was designed by people who understood exactly what they intended to reward. The people who wrote it were not employees. They were owners, investors, and individuals whose income arrived not as wages, but as equity, capital gains, and business revenue. The code reflects that. It cannot reflect anything else. Here is the mechanical reality. An employee earns income, pays taxes on that income, and spends what remains. The sequence is fixed. There is no flexibility in the order of operations. A business owner earns revenue, spends money on legitimate business expenses, and pays taxes only on what is left after those expenditures. The sequence is different. That difference is not a loophole. It is the architecture of the system. It means the business owner is operating on pre-tax dollars for every qualifying expense, which is a structural advantage that compounds across every financial decision made in a given year. Capital gains, the profit generated from selling an asset held over time, are taxed at rates subject to significantly reduced treatment compared to standard wages across most jurisdictions. Ions. The person who earns by owning is taxed less than the person who earns by working. This is not a hidden provision. It is written plainly. Machiavelli observed that laws are never neutral documents. They originate from individuals with the authority to shape them, and they reflect the interests of those who created them with a consistency that should surprise no one paying attention. The tax code is not an exception to this principle. It is a confirmation of it. These rules are not classified. They are not restricted to a particular class of people with the right credentials or the right connections. They are publicly available, professionally documented, and fully legal. The reason most people don't use them is not complexity. Nobody taught them. The code was always written in plain sight, simply never communicated to those whom it harms most. Debt is bad. Avoid it. Pay it off. Treat it as the enemy of financial security. This is the lesson delivered most consistently across homes, schools, and a century of cultural messaging, and it is not entirely false. Consumer debt on things that lose value destroys wealth. The problem is not the warning. The problem is that the warning makes no distinction between two instruments that share a name and operate in entirely opposite directions. Debt used to acquire a depreciating liability and debt used to acquire a productive asset are not the same thing. Calling them both debt and attaching the same cultural fear to both is the equivalent of warning someone that fire is dangerous and watching them refuse to cook. Leverage is borrowing at 5% to acquire something producing 8%. The spread is the point. The wealthy do not avoid debt. They engineer spreads with it, using borrowed capital to control assets that generate returns greater than the cost of the borrowing. The poor pay 20% interest on cars and appliances that are worth less every year. Same instrument, completely opposite application. One side collects the spread, the other side is the spread. Machiavelli understood that every tool reflects the intelligence of the person who holds it. Debt in the hands of someone who has never taught the mechanics is identical. School delivers the cultural warning. Debt is dangerous. Avoid it. Pay it off. Without ever delivering the structural education that explains why some people use that danger as a foundation. Not because the education is unavailable, because a system designed to produce reliable employees has no incentive to produce people who understand how capital scales. The same instrument that keeps millions trapped is the one that built most of the world's significant fortunes. The difference was never the debt itself. It was whether the person using it understood what they were doing. The conventional wisdom surrounding professional networks emphasizes quantity. Attend more events, add more contacts, stay more visible, and it produces networks that look impressive and function poorly. A contact who does not think of you when an opportunity arises is not a network asset. They are a name stored somewhere that neither of you will revisit. The size of a network is not the variable that determines its output. The density of genuine self-interest inside it is. Most people have optimized for the wrong metric. They have collected connections the way school taught them to collect credentials, as if accumulation itself were the point. It is not. A real network is not a list. It is a web where the other parties have concrete, specific reasons to think of you before you know an opportunity exists. That distinction is the difference between a network that chases and a network that attracts. Machiavelli observed that the most durable princes did not surround themselves with advisors who merely knew their name. They surrounded themselves with people whose own success was structurally tied to the prince's success, allies with genuine self-interest in seeing them prevail, not acquaintances performing loyalty. The relationship was not transactional in a shallow sense. It was architecturally mutual. The question to ask is not how many people you know. The question is for how many people have you solved a real problem, removed a real obstacle, or created a result they could not have produced without you. It is also the only number that matters. Every person who carries the specific memory of a problem you solved for them is a node in a network that functions without your effort. Those whose obstacles you have cleared will keep your memory alive, and that is the only form of network that ever pulls opportunities towards you rather than requiring you to chase them. The market does not have a precise instrument for measuring what something is actually worth. It has only the price at which transactions clear, and that price reflects perceived value, not real value. In a world of perfect information, they would converge. Markets do not have perfect information. They operate on signals, reputation, credentials, confidence, social proof, the coherence of the narrative you present. These signals are manageable. They are also only loosely correlated with the substance underneath them. Superiority in product does not always win out. Strategic positioning does. The most qualified candidate does not always get the role. The most legible one does. Substance without positioning is invisible, and invisibility in a market where attention determines selection is functionally identical to non-existence. The market cannot reward what it cannot see, and it cannot see anything that has not been made visible through the signals it actually reads. Machiavelli understood that power was never held by the most virtuous prince. It was held by the prince who most effectively controlled how he was perceived by those whose support he required. A prince with genuine capability and no presence was as politically irrelevant as a prince with no capability at all. The same structure governs every market transaction. You are not evaluated on what you contain. You are evaluated on what you project, what others confirm, and what story the available evidence supports. Managing that story is not dishonesty. It is the structural requirement for your real value to ever become your compensated value. Talented people who treat self-presentation as beneath them are not maintaining their integrity. They are guaranteeing that their actual capability never reaches the people who would pay for it. Hidden talent and no talent produce identical income. The market cannot pay for what it cannot see, and the gap between what you are worth and what you are perceived to be worth is the most expensive lesson most talented people spend their entire careers never learning. Compound interest, the phenomenon where returns generate their own returns over time, is presented almost universally as one of the most powerful tools available to the patient investor, which it is, and that is exactly half of the story. The half that gets taught is the inspiring half. A modest sum invested early, left alone, growing at a consistent rate for decades, becoming something extraordinary through no additional effort on the part of the person who holds it. This is accurate. This is real. And it is precisely as accurate and precisely as real on the other side of the equation, which is the side the financial system never volunteers to explain to you. Consumer debt compounds. It multiplies. The balance you carry today becomes the base from which next year's interest is calculated. And the year after that, and the year after that. A person holding a substantial credit card balance over 10 years does not owe principal plus a decade of flat interest charges. They owe a number that has been compounding exponentially in the wrong direction for the entire period. The same mathematical force that makes patient investors wealthy is making that balance larger every single month, whether or not a payment was made. The financial system is not neutral on this question. Wealthy individuals and institutions sit on the collecting side of compound returns. The majority of the population sits on the paying side of compound debt. The spread between those two positions is not an accident. It's the fundamental profit mechanism of the industry, and it requires a large population of people who have never been shown clearly what is happening to the number on their statement. The system knows which side of the equation you are on. The question is whether you do. Compound interest is either a blessing or a curse, depending entirely on which way the force flows, and most people are kept unaware of which way their own is moving. Don't put all your eggs in one basket. Perhaps the most commonly cited axiom in mainstream investing circles, the foundational principle of most retail investment advice, and in the context it is most frequently applied, a near guarantee that you will never build significant wealth. For a portfolio lacking the investor's specific understanding of any individual holding, where every asset is held because a general allocation model suggested it, diversification is a legitimate risk management tool. What it cannot do, by mathematical definition, is produce returns that exceed the weighted average of everything you hold. When you own 30 assets, your upside is the blend. You are purchasing the field, and purchasing the field produces field returns, minus fees, minus the drag of the positions you held that went nowhere. Consider what this means structurally. The investors who have produced extraordinary generational returns, not index returns, not market average returns, but the kind of compounding that builds real wealth in a single lifetime. Concentrated. They found a domain where they had genuine understanding that the broader market did not have, a structural position that gave them visibility others lacked, an information advantage built from the kind of lived experience that cannot be replicated from a brokerage dashboard. They went deep into the thing they actually understood and sized accordingly. Concentration of force at the point of real advantage is not recklessness, it is strategy. The risk of concentration is real. The risk of permanent mediocrity through perpetual diversification is less visible. Managing concentration requires genuine edge, deep understanding, real positioning, honest assessment of where your knowledge actually ends. That examination is the part most people skip. They accept the assumption that they have no edge because no one ever asked them to question it. Diversification is the financial approach embraced by those convinced they will never cultivate a genuine competitive advantage. And before you accept that, make sure it is actually true.